Hey guys, so in this video we're going to talk about the stock market, something we've all heard of before, whether it be on the news or in films. But in this video I really want to drill down on how the stock market works and how you can make money from it. So the first takeaway is that every country generally tends to operate their own stock market. You don't have one stock market in each country, however. You're going to have different exchanges operating for different reasons. So on the screen here, we've got the top 10 stock exchanges operating across the world by market capitalization. The largest exchanges are in the US. You've probably heard of the New York Stock Exchange or the NASDAQ, but you've got other exchanges across Asia, Europe, and Australasia. So TradeWinds, we're focusing on the US exchanges where there's about 4,000 listed stocks there. And one of the main reasons for that is because the US offers fractional shares. So that means you don't have to buy one share outright if the price of one share is really high. If Amazon, for example, is trading at $3,000 a share, you don't need $3,000 just to go into the US markets to buy one share. You could maybe buy $50 or $100 worth of that share because of the fractional offerings that they have. If you look across Asia, for example, you want to buy some shares, say in Hong Kong, they actually have minimum share volumes. So it's 100 or 500 shares in Hong Kong. If you want to buy one of the big banks in Singapore or Malaysia, the minimum lot size there is 100 shares. So we've got to focus on the US stock exchanges. We've got the two biggest stated here, but there actually are a number of other exchanges which we'll reference in this video. And in the past, you wind the clock back 100 years, you actually had people, on a trading floor, as you may have seen in old films, people frantically shouting across the floor to each other in a literal marketplace, buying and selling stocks and shares. You forward the clock 100 years, and things have obviously become a lot more automated and digitized through computers. This obviously the New York Stock Exchange trading floor, obviously not normally this quiet. This must have been a photo taken before the markets opened, but each market opens and closes within the time zone of the country that they operate in. So in the US, we've got about actually 20 exchanges. We touched on the New York and NASDAQ exchanges, but you've got other smaller exchanges that actually operate in the US as well. Chicago, for example, has its own stock exchange. There's the Miami International Securities Exchange, the Boston Options Exchange, etc. And the other key takeaway here is that each of these exchanges has its performance measured by an index. And the indices are important because they show the relative performance of the stock exchanges to each other, say within the US, but you can also chart those indices and see how different countries' stock exchanges compare to each other as well. These are some of the most well-known stock exchanges. So the oldest in the US is the Dow Jones Industrial Average, which is an aggregate of the top 30 companies, founded in the late 1800s. You can see this on TradingView via the ticker DJI. You've got the S&P 500. I think is fairly commonly known as a stock market index, founded obviously slightly later in the late 50s, and this is the top 500 businesses within that exchange, and the ticker is SPX. And then more recently, you've got this focus on the technology companies. You've got the NASDAQ 100, founded in the mid-80s, ticker NDX. So we have different exchanges within the US with different indices, and each exchange typically offers different stocks. So these are the top 10 stocks by market cap globally. as at the time of making this video, you've got a company like Apple with a market cap of just over $2.5 trillion. And that Apple stock trades on the NASDAQ, as well as companies like Microsoft and Google. You know, these tech companies tend to trade on the NASDAQ. Then you've got something like Berkshire Hathaway, which is Warren Buffett's business, and that trades on the New York Stock Exchange. You might sometimes get these shares available in local markets, so they may have a share that you can pick up in, the UK or Australia, etc. But it varies very much by the country and the company that you're interested in. So, if you take only one thing away from this video, it's that yes, the market can correct, and yes, we're often hearing stories about market corrections and the risk that obviously goes around investing in the stock market. But although a lot happens in the world, generally the trend is up if you were to invest in the stock market for the long term, which is one of the key things that we emphasize here at TradeWinds. So if you look at the US stock market over, say, the last 100 years, sure, you've had lots of military conflicts, World War I and II. You've had war in Korea, Vietnam, the Gulf, Bosnia, Kosovo, and more recently in the Ukraine. We've had market drawdowns, so the so-called panic of 1907. We've had the Great Depression of the early 30s from 1929, Black Monday in 1987, and of course the global financial crisis more recently in 2008 and 2009. So things happen in the world, but in the long term, when you take a step back, if in doubt, zoom out, you can see that the general trend is up. And obviously, there are going to be some years when the market goes up, and there'll be other years when overall the markets go down. I've run some numbers here to save you doing all this yourself manually. But if you look from where the market opened in January every year, and then you compare to where it closed in December, you can see obviously that you've got some years in green. We had 69 years out of the last 100 where the markets closed higher at Christmas time. So at the end of the year, we had like a positive candle. There were 30 years in the last century where the markets closed at a loss. And bizarrely in 2011, we had this sort of year where the price was the same in December as it was in January. So if you look at this in a percentage term, there's about a 69% chance that in any year you enter the market, it's going to go up. So the majority of the time, the markets go up, and in the long run, they certainly go up. And so, we've got a general uptrend here. And if you look at, say, the last 100 years, you did a measured move from 1922 to the year 2022, the stock market actually went up nearly 64,000%. So it's worth bearing that in mind when you get these short-term corrections, where we've had COVID recently. For example, markets did take a dive. In TradeWinds, we are exploiting that temporary mispricing of stocks and shares, and we're obviously looking to pick up shares in fundamentally sound businesses when the price retraces below their intrinsic value. Now, that's not to say all stock markets go up all of the time across every country. So this graph is now comparing how different countries' stock markets perform against each other. So the red line up here is the NASDAQ 100. If you look since 2004, that has seen around 1,200% growth. And then you've got other markets like the S&P 500, as well as the New Zealand markets, and also the COPSI in South Korea as well. And this is important because when you come to build your portfolio, you obviously want to maximize your chances of your assets going up. So you want to invest in countries that are experiencing the biggest growth across the world. And the US certainly offers that currently. So why does the stock market generally tend to go up in the long term? Well, one of the things, if you think about these groups of businesses, is that there is a focus only on the best businesses. So the S&P 500 is the 500 best businesses in the US. In the UK, we've got the FTSE 100. It's the 100 biggest or best businesses that comprise those markets. Same in Germany with the DAX. And I suppose one of the best ways to compare this, in my mind, is with, say, football teams. So in the US, you pick a sort of random team. You've got the New England Patriots. This team has been around for over 60 years. Obviously, on the field, players come and go. They're not still playing the same guys from 60 years ago. Much like in the UK, we've got Manchester United, a football team that's been around for around 144 years. Players get brought in, other players get put on the bench, they get retired. But the team is still the team, right? So the S&P 500 is the top 500 businesses in the US, and that auto adjusts every year so that you're only investing in the best of the best. The other reason why the markets generally tend to go up in the long run is because there's simply more people, there's more population growth across the world for these businesses to sell their products and or services to. And obviously, recently we've had this narrative of inflation creeping in as well. If those people are prepared to keep paying slightly more for those goods and services, then that is going to increase the value of that business and that share price. So both population growth and at times inflation, that is going to drive those longer term fundamentals up as well. Now, on the screen here, we've got a couple of well-known celebrities, whether these guys come from, the worlds of sport or music or film. There's no doubt that, Ronaldo, Eminem, Brad Pitt, etc., just three guys I've picked at random here, have made, substantial sums of money in their career. They're very well known to everyone, and they've done very well in life, right? And I'm a fan of all these guys. However, you've got other guys who you may not have heard of, who have also tried to grow their wealth in the world. And these guys are investors, right? So they've adopted these principles of choosing the most financially sound businesses, and they've managed to grow substantial portfolios of assets. Warren Buffett worth $118 billion, etc., etc. These guys are at another level of wealth, and they've obviously come at it in a different way to other celebrities. So how do you do it? How do you make money out of the stock market? Well, if you buy wisely, and that's something we hope to educate on at TradeWinds, you can make money through the growth in value of a stock. So let's say 10 years ago, we pick up a share of Apple, right? In 2012, you could do that and you buy one share of Apple for say $15. You hold that share for 10 years, so that today, maybe one share of Apple is now worth $165. So in the 10 years, you've grown your money by 1,000%. And it's much like buying a property. You can buy a house, and 10 years ago, you'd expect to see some growth in the value of that house. So the first way of making money is to simply buy and hold stock for the long term. Warren Buffett famously says, if you're not prepared to hold a stock for 10 years, then you shouldn't hold it for 10 minutes. We're not actively trading here. We've all got busy lives. We're looking to invest for the long term through a buy and hold strategy. So capital appreciation is the first area. And then the second way you make money is through dividend payments. So as we can see here, dividends are the regular distribution of a company's earnings to the shareholders. And again, if you use that analogy of investment property, if you buy a property, you rent it out, the tenant is going to pay you rent every month or every quarter. It's the same with a stock. If you own a stock, that business is going to pay you out a dividend on a quarterly or half-yearly basis. And different companies obviously pay out different amounts of dividend. Generally, you find the older businesses that have been around a lot longer, they've scaled sufficiently, Procter & Gamble, 3M, Coca-Cola, these guys have been around for a long time and they are paying out some of the biggest dividends. And you can Google this, the Dividend Aristocrats, This is a name given to the group of businesses that have consistently increased the dividend every year. So you can see here Procter & Gamble, for the last 65 years, they have paid out every year slightly more dividend than the year before. You get other businesses that, that focus more on their own growth. If you look at Amazon, they're not paying out as much dividend because they're like reinvesting those earnings and profits back into the business to scale it even more. But if you're looking, for dividend investing, then these are the types of businesses that you might realize that from. The other general point that you need to know is that different companies obviously have different share prices. Obviously, that's fairly self-explanatory, but just because a share like Unilever might be worth $44 and Amazon might be worth $3,000 a share, doesn't mean that you should just go and buy Unilever because you think it's cheaper, right? Oh, $44, well, that's a lot less than $3,000, it must be cheaper. No, doesn't work like that. The value of each share is relative to how many shares are actually available to buy. So Unilever actually offers over 2.5 billion shares, right? So obviously if you've got so many shares, when you divide the value of the business into the number of available shares, each share is going to be worth less. Amazon, on the other hand, it doesn't have 2.5 billion shares to offer the world. It's only offering markets about 500 million shares. So of course it's relative to the market cap and future earnings potential of these businesses. But if you divide that generally into the number of shares available, that is what gives you this price per share. And in our next video on value investing, we'll go into more detail around how to define what the intrinsic value of a business is, and then how to make sure that that current price is lower than the intrinsic value so that you can pick these businesses up at a discount when they go on sale. The final thing I'll end this video on is the emotions that go around doing this. So you really can't understate this. If you talk to people that have never invested in the markets and you ask them, what do you think about the stock market? 9 times out of 10, they're going to turn around and say, it's risky, it's a casino, I'm going to put my money in there and I'm going to lose my money. Well, that is based on fear, right? People are afraid of things they don't really understand or things that they haven't had a lot of experience about. And you've got to reconcile that with the slide I had earlier of someone like Warren Buffett. If it's so risky, how has Warren Buffett managed to amass a fortune of over $100 billion, right? So most people have this conflict in their mind. They can see that there is value and wealth to be had out of the stock market, but equally until they've done it, they're afraid of it. And they've got this fear. On the complete extreme opposite, you've got greed, which is the other basic emotion that people can have when talking about this. And these both emotions are dangerous, right? They lead to irrational decisions. Our key focus as long-term investors is to maintain objectivity, stick to the plan. Sure, things can go up and down in the short term, but you must stick and be committed to your plan and stay the course in that sense. And look, it's not difficult to understand where some of these emotions come from. A lot of it is wound up by the media. So obviously the other year when COVID occurred, that happened to be the big scare of the day. You'll flip on the news and there will be panic, there will be selling, and you've got that fear obviously being spread. But equally, you might have a week where the markets are up and everyone's really greedy and they want to buy more and they're making money, and money is this kind of massive motivator for us. So just be mindful of that. Don't let the emotions override your logic. Be objective. And you can even look at this, which is of CNN Business, an index that actually quantifies in real time where the market is at. This is a free tool that you can use by following this web link here. And basically it's a score out of 100 where they are trying to quantify market sentiment. Anything from 0 to 50 is fear. So I actually did this the other day, and at the time of recording, we were at 42 out of 100, which is fear. If it drops below 25, you get to extreme fear. And then obviously 50 to 100 is greed, right? And if it's over 75, you're in this extreme greed where everyone's looking to buy. We're all really excited to make money. I'll just leave you with one thought, and it's this very famous quote from Warren Buffett. And this talks to like a contrarian approach where you kind of do the opposite of the herd. So if everyone out there is being really greedy, you want to be afraid, right? Because the market's probably going to be topping out. But he says, be fearful when others are greedy. So when the market's at the top, you don't want to be buying like them. You want to be greedy when others are fearful, i.e. when the market corrects itself, there's a bit of uncertainty and panic in the market. As long as you're scooping up the best businesses, you can get them at a discount when they're cheaper to buy. And so, you know, you can see the markets go up, but they never go up in a straight line forever. They're always going to pull back. So you can see here in the late 90s, we had this big kind of run up into the tech wreck, the dot-com crash of 2000, 2002. You had then another sort of recovery off of that. You had the global financial crisis, it went down. And obviously we've been on this big tear up ever since. So, you know, you don't want to be buying up here. You don't want to be buying at the top because, sure, if you put money into the market there, it's been going up and up and up every year, it may be more likely to come down and have a correction. And then what most people tend to do is listen to the news, they buy at the peak greed, their money then goes down the toilet and they sell right at the bottom here and they lose money, right? That's the worst time to sell. Obviously, we're looking to do this for the long term. So you want to buy the low. If you buy the low, you can't lose money because it's, you know, gone down enough. You want to be buying here and then only doing so with the most robust businesses. And it's to a discussion around this value investing concept that we're going to turn to in the next video now. Many thanks.